It's a crypto sniper here. How are you guys doing? Yes, gonna handle the indicator fallacy. It's one that you never finish handling. It's like a vampire that you have to just keep hammering the wooden stake right the way through. It just came about. Interesting share. We're looking over here. All in good spirited stuff. There's no bad actors here. Everyone's just talking about what they do. And I'm just going to give you my take on the use of indicators. Now, when I say indicators, I'm referring to the larger general category, which is price data manipulated by mathematical formula. That doesn't mean it extends to Bollinger Bands, volatility, or volume based. Volume is separate data. Volatility is a separate measurement. Hear me? And things like Bollinger Bands actually track a volatility as well. So we are very geared towards low volatility to high volatility expansions, and is great. And I consider it probably the most valuable aspect of technical analysis and the most key point when you can get in with very tight risk and expansive rewards. So don't mistake that most people have a very undefined all indicators. Lots of things get called indicators. Even sentiment can be called a sentiment indicator. It is different data. It's about the mood of the people. So those are different. I'm talking about maths formulas applied to price data indicators, that category, and it's a subsector of what most people generally refer, but it's one of the largest subsectors. So I'm being referred affectionately, I would like to think, as an indicator hater. So I talk often about it, and I often do exactly that. And my reason is it's not supporting you, and in fact it's giving you a false sense of security. You think of the kid, I don't know if it's Lois in Charlie Brown, sucking his thumb and holding his security blanket, and the minute you try separate him from the blanket, give it up, you'll survive, and take his thumb out of his mouth, he's like people need stuff thrown on their charts. We do everything to take us away from actually having a naked blank sheet. It's almost like blank sheet-itis for writing a book. We do everything. We'll copy and clone some other person's work and rewrite it and input words in and change it up and try and make it our own. No, the blank sheet is the start. The blank chart with just the price is your most powerful indicator. The things of great value are leading indicators, not lagging indicators. Leading indicators are things such as volatility squeezes, which we've told you, volume, and patterns, and they are all on balance of probabilities. So they are leading by nature and give you a higher possibility, potentially even to a probability, if people like to think of probabilities being higher, but you can actually have a 1% probability out of 100. Probability is a mathematical term rather than an English term where you think it's more likely. So you will get possibilities and probabilities, but the actual correct mathematical handling is, of all outcomes that can happen to me, I'm going to die. Which one is it? And 1% is a probability. It's 1 in 100 that I will die by a grand piano falling on my head. That's actually quite high for that kind of a death. But anyway, so the point of that being is probabilities, when they're all added together, should come out to the 100% whole. So you get an increased likelihood when you have patterns in your favor compared to random entries. You get an increased likelihood if certain criteria that are well specified on volume and volatility also are in your favor. And if you can get the directional element correct on the volatility squeeze, you actually get a very beneficial trade. So our trading methodology is wholly based around that. But I regularly get people that will challenge me on the value of indicators, and they'll put up very compelling draws. And a decent gent, as I say, no bad, but this is a concept discussion, so not a personal attack in any way. So if we have a look at the link that he shared, this is what he shared, and it's a nicely drawn chart. It's done well. You know, I respect people that put effort into their charting. Whether conceptually I think some of the aspects are wastes of time or even counterproductive is a moot point. someone who's made an effort to do good charting, and this gentleman has, or lady, not entirely clear, guessing a gentleman. And not everything also is bad. So let's start with what we like before we sink ourselves into the more teethy part of what I'm going to be discussing today in the indicator fallacy. So crypto folks that are starting to watch charts, starting to get maybe a little bit interested in charts, tell me this, tell me that, got sucked in because of get rich quick and Bitcoin. We all start like that. So did I. I'm no better than you. I'm not trying to be a saint here either. And then we learn a skill. And we have to learn a skill, and then we realize the best game is getting rich slow and understanding money management, having a real setup and having a real process and adhering to it. So we're all in various stages of growing this, and I've still got many more things to learn and grow. So we're all on a journey. There's no supremacy in anybody here in this. But I will say, to me, in all my years of trading, I've eventually come to the following conclusions. And if this short circuits errors and false securities that you build, I've done you a favor, and it will hopefully make you successful sooner and quicker, whether you elect ever to engage with me or not in a professional context and learn about HVF method. So first of all, what I do like that he's done, and I applaud it, is the breakout of key selling grind lines. Now, many people will refer to this as trend lines. Trend lines got, for me, as a phrase, conceptually, a little bit spoiled, because often we would do trend lines in very small time frames where actually there is already a governing trend that is being dictated on a much higher time frame. So you have to also refer and chop your analysis up into what time frames are you doing your analysis on. If you ask me if I'm bearish something, I might be both bearish, bullish and neutral on the same underlying market, just on different time frames. So it's very important to understand that time frames are very critical. Now, we get grind lines on low time frames and we get them on big time frames. It transcends time frame. It can be significant. Trend lines should generally be used for macro where a dominant trend prevails. So in this instance, that's why we have slightly different phraseology to avoid this confusion. Anyway, in this particular instance, he is highlighting the bear trends on a macro chart of Bitcoin. This is what we're looking at, a macro chart of BTC against the dollar, done on a weekly time frame. And what I like about what he's done here in terms of good work is that he's showing the descending of the selling across the tops. So when you get rallies in bear markets, you can often get a gradient of descent, that dawning realization that you should be getting out and people getting out, the smart money that doesn't panic and hit the bid and the offer on their trading, tends to sell out on peaks of minor rallies. And this is what sets up these black lines, red lines, and red lines over here. So he's done two different colors. I'm not entirely sure why, but nonetheless, good work. And he's highlighting, you know, that high was sold. Of course, the original high was sold, a little bit of distribution there. And then when you trade through that, that is showing that the gradient of descent of the ever more aggressive holders that want to get out on rallies, more and more dawning realization of the bear market, has now succumbed, and that rate of descent has changed. So that means you're no longer accelerating or you're no longer even just continuing at that rate of sell. So that points to a possible turning, not always a guaranteed turning. And it's important to recognize that these lines are drawn in retrospect. In other words, other lines could have existed before that all failed. I'll give you a small example using the exact same chart. Bear market over, yay! Rally, new low. Wrong. Okay, let's try again. Bear market over. You know, nipping the top there, nipping the top there, nipping the tops there, nipping the tops there. Rally, yay! Turned. No, a new low there. So you can, the final one is always the one that's drawn when we do retrospective analysis. This is what I call a sort of eye candy effect. We all do that. I do them retrospectively as well. So that's not a criticism. It's just a fact. When we retrospectively analyzing something with the benefit of hindsight, we put the lines in the place that best represents that flip. But actually, there could have been many other lines that could have been drawn before that, that all failed before the one that won. And we don't always ask that. We all think we could be Leo Messi, but we forget how many footballers that never even got out of second or third division playing football, no matter how hard we tried. We just didn't have the genes. And even if you ever get to the Premier League, you become a name that's forgotten in a very short time. So then we remember the one instead of realizing the failure of the many. Same with rock groups becoming a Hollywood movie star, terrible idea by the way, etc., etc. Again, here, another draw you might have done at one point could have been across the tops like that. Could have even been like that. And then you get the one that worked. So this is, we have to recognize when we are doing, and we do this in HVF method, we talk about retrospective. So we are being honest and not bullshitting ourselves. It's very important the language you use. This is just an additional learning. This is not about this particular individual's draw. I like what he's done here. This is just a key point. When we go backwards and we say, with retrospective analysis, here's my historical draw with the known outcome. So what you're doing is you're avoiding being smarter than you really are, and you're acknowledging that the outcome was known and you're now doing the draw that best held for that. For anything it benefits you in the future. Now generally, angled lines don't tend to benefit you in the future, which is why topic number one covered by us is key levels of significance, which is actually horizontal levels that have shown their significance, that are turned into rays that perpetuate forever and do become significant again for you in the future. And that retrospective analysis provides you with fresh information on every chart. So when I go to a security that I haven't looked at in a while, but I've done historical analysis on, instead of a blank page, I actually already have a fulcrum skeleton of key levels of significance from previous work that remains on the chart and has been projected forward. The angle lines lose their relevance, and in my community you'll often see me removing them after the falling wedge has played out, the rising wedge, the whatever, the capping grind lines. So these are interesting in retrospect, but actually in terms of anything that happens today on Bitcoin, these have no value. However, a historical high that you might be at projected into the future is potentially quite significant in terms of where the price behavior is today. So I think that concept can be understood, and I like the work, and it's nicely illustrated and it's well done, and credit to him for doing that. So these dots are what they call support and reversal. SAR, it's called SAR. I have to remember what it is, support and resistance reversal. So they put the stop loss on when you should be short, and then it pivots. I did all these things at one point, and I've forgotten all of them because I just don't use them. I just don't use them, and I don't expect to get good outcomes. And then, so in the response to this video, there will be a lot of people just because they'll come with this answer. So let me just preempt some of the people's responses. Just because you weren't smart enough to make an SAR or a MACD or a stochastic or a work for you, doesn't mean that our systems don't work. And I'm afraid the answer is wrong. Your systems don't work. That doesn't mean you haven't got into good trades and made money. And that could be other reasons. You're getting in early into a new trend, you got in, you think it's your MACD crossover, your SAR, you've actually gone long and you've locked in some money. There'll be other aspects of fortune that you might have done correctly, inadvertently, that you're less focusing on, that has seen the market move up. And in some instances, if you have picked the one and you've arrived at the time, you will get that particular draw, and you might get that particular moment. So I'm not saying everybody who ever trades with the indicator never has a winning trade. I'm just saying the contribution you think has been given to you by indicators or particular aspects that you are making pivotal to your strategy often is far smaller than you realize, and it's the price. It could have been done with the price. These things move up, a MACD breaks to the upside because the price, which is the driver in his turbocharged truck pulling the dead cow out of the river on the muddy field, putting his foot down on the accelerator and guiding with the steering wheel. That's what's pulled it up there. And the dead cow, which is the MACD indicator that is lagging, dragging behind, is moving in that direction because of the accelerator and the steering wheel that the driver inputs are putting into the vehicle that is the only thing that is providing energy into the situation. The cow is dead. Okay, when it crosses behind you because you've got a tow bar with a rope dangling behind it, it hasn't suddenly created a signal. The cow is dead. It's crossing behind you because it's doing an exaggerated lagging momentum thanks to a slack in a rope dragging behind you, but it is going to approximate what you're doing in a generally smooth arcing manner behind the real price. And that's what everybody wants. Nobody wants to read the detail of the price behavior. They want that just to give me the nice easy ebb and flow behind. Give me the dead cows dragging right behind the 4x4 rather than the inputs, that is the accelerator, the traction of the wheels in the mud, and the steering column that the driver is actually putting in. And that is your pattern, your volatility, and your volume. Those are the key aspects that will give you inputs. So my comments are not a hater of anything, by the way. Hate is a strong emotion. I don't have emotions towards anything. I would just like for less traders to throw their money away on indicators. And in the long run, when I actually captured all my trade records, trading indicator strategies, the long run, despite winning trades, mental enrichment, we always remember those big winners, but we always seem to be putting more in than in the long run out. And then you take some money out a few times and you think, that's it, I'm up. And then you forget how much you took and put in. Do your year and year P&Ls and see how much indicating strategies have cost you. Long run. And we will talk about optimization and something that is coming in when we look at the next bit lower for that. And again, you could even have a winning year, a substantial winning year by being a long-term holder or by trading generally net long on something that's generally net up. Let's be clear, when we said the dollar index at 89 was going to run 111 on the Dixie, if you're just only gone long broadly and you weren't 5-minute trader, you're having a reasonable time frame, and then you would eventually close, let's say discretionally, or a monkey throwing a dart at a board after 3 or 4 days, you actually would have had more winning trades and would have had a positive P&L for that year. I can absolutely assure you. And that would have been because you were going net long, you had a reasonable holding time on something that was going up. And it wouldn't be your MACD, it wouldn't be your rewards. In fact, the random reward monkey dartboard would probably have given better outputs and exits, providing you had good money management than average money management on an amazing customized MACD entry or other indicator such as an ADX. Many of these, as I say, I ran into, they're all the same. They're all the same. So let's go into the middle bit of this. So we've said what we've said on grind lines or trend lines as they've been put, useful for indicating that a certain rate of descent has now passed. Okay, all understood and well. So the case here, I mean, Bitcoin is bottoming. It's all a long draw. Remember the cautionary that, you know, many people called the bottom here, and we were one of the rare that were short on an inverted HVF. The lines they would have drawn would have been like this on that period. We've already broken. Only to see it go up, come back down, and then have to draw another line. So on its own, a trend line or a grind line is not going to be a reliable entry strategy, because you will see that you could have had 2 or 3 of these draws long before you actually got one that was right. So you are trading a reversal game instead of a continuation game, because in a bear market you are continuing to call a bottom on mainly a belief-based bias on that Bitcoin is sounder money than dollars on treasury notes, etc. And as a result, you're perpetually calling bottoms on something that's gone down, down, and down from 69 and has in fact traded in the 15,000 range. Okay, so let's have a look at this. Now I can tell you on this particular indicator, I'm not even too sure what it is. I found it, it's a custom indicator that looks like what somebody's written. And then when you have a custom indicator that does interesting things, so the bias signal, what I can deduce is the bias signal is being generated on the crossover from the green into the yellow line, and the big call is, this is a Bitcoin long. This is a Bitcoin long. And now you've got essentially what they think is 3 different reasons, because there's a third indicator at the bottom, so there's 3, for what is actually one price move. One price move. And this is the problem with indicators. Once you start with 1, you have 2 or 3 and 4. And because they're all based on price, many of them will trigger in and around, not always on the exact time, the same thing. And it gives you a false sense of confidence. In other words, you think there's 3 reasons why you should be going long, because that one says so, that one says so, and that one says so. First of all, they say nothing. You've designed them, you've optimized them for a certain data set, and this is a bias that every trader has. Line crosses line. We're all snipers. I should come in here with my crossbow. I've got a telescopic sight on it. Why? Because we all love line crosses line. Hell, I'm the original market sniper, the crypto sniper. People understand line crosses line. This is an event. And we walk around and we all look for, when do I do something? Here's your call. Sniper sight, line crosses line. And now you have 3 what looks to be independently different reasons for line now crossing line. 3 times over, must shoot. Absolutely. Meanwhile, it's one price move that over 3 different indicators, but they're actually all functions of price in some way being manipulated, have all simultaneously given the reason for the same one reason. The price moved significantly more than it has to the upside in a while. That's it. So you actually think you have 3 reasons when you have 1. It's all dictated by the price. It doesn't matter if you have 3 ropes off the back of your 4x4 of different length, all pulling different sizes of dead carcass. The fact is, you haven't had 3 new reasons that the car's going left. The guy turned left. The driver turned the wheel. The guy who's got his foot on the brake, the accelerator, and the wheel has made it go left. It's one reason manifesting in 3 ways, all saying one thing. He's turned left. Okay, let's get on with it. So these things can be optimized. And I want to point out that Bitcoin on a macro time frame for its history is very much a bull, a bear, a bull, a bear. Quite simple until broadly we got a large continuation pattern pretty much here. So you got an extended delay before you went up. You can see that was supposedly a beginning of a bull, only for you to trade very close to the low there. That was a long time apart. These were the dearth and depth of the lows of November 2018. We traded it short. I'll never forget that day. It was an instant 6-digit trade for us at the time to the short side. And then later you have March 2020. March 2020, guys. So you've gone from 18 to 2020. Now it was November 18, but you've still had all of 19. You've had 2 or 3 months of 18, and you've had 2 or 3 months of 2020. So you've gone for the better part of 18 months. And 6 added on to the year, you've got about 18 months of up, down, without making any new high or anything else. And that's why you're lucky that that triggered up. But look how many times it triggered if you had any form of indicator on the yellow and the red. It didn't simply go out the top at all. You had both ups and downs for it. And it did come some way. But if you had the wrong settings, and all these settings can be optimized to give the perfect signal. So what happens is you have indicator DNVT. You optimize it so it gives you the best triggering signal for this. You change all these variables that are inputs until you get a long, roughly when it was roundabout time to be long. It's late if in terms of the low. It's again reasonably late here. Let's go vertically, but not chronically so. They're decent signals. And now it's calling now, only it isn't. It's just line crosses line. But anyway, the notion is you optimize those. You have optimized the indicator for a specific data set that is the data of price for Bitcoin from 14 to today. And let me tell you, that data for price from 14 to today, a period of 8 years, is going to experience a totally separate data set for price for the next 8 years, 22 to 30. And the shocking thing is that optimization, when it's optimized and given good signals for a specific set of data, which you only tend to get much later after you've triggered 3 big bull triggers, people only say, look how good this is now. So they're only getting this as a tool now. You didn't have it at 2014 with just one signal. So it's only become useful to you now. For the data set you've had, you now go into a totally different price data environment. And as I was sharing on crypto and on the yield inversion curves, we have the biggest inversion ever on the macro. And we brought macro to crypto people. We said this is a function of dollar. You're going to battle during a dollar bull period. It's not going to be your own way. It's a headwind. You've gone from a tailwind. The big run from the 10K to the 69K was driven by a plethora, an absolute plethora of liquidity generated by the central banking cartel following the events of March 2020, the needlecraft narrative. And what's ended up happening is a major pumpermentals in liquidity and high risk beta that took Bitcoin to 69, that subsequently reversed quite violently with the dollar and brought it largely all the way back to 15. So something that went from 10 to 64, pulled back to 30, went to 69, has come back to 15. You've not held that much of that growth. It's a 50% growth from the point of break for us on the first cup gold nugget. And that took trillions being thrown globally macro into the environment to take it up that far. Now, if crypto shakes off a lot of things and becomes an independently viewed asset class, which it hasn't until recently, it's been treated as a tech proxy, a high beta tech proxy at the moment. Until it starts to have its own drivers again, we see real loss of faith in the dollar and treasuries and every other asset class for retaining wealth, and apart maybe from gold and silver, and you see them go together. That's why it's stupid to be anti-gold or silver. The risk on environment and the failure of money, you want to see money going into gold and silver if you're Bitcoin, because then some of it will be coming to you too, providing you are delivering on what you claim to be digitized scarcity that has been programmed to be scarcity, where the other things are physically impossible to be proliferated at a grade level because it takes so much energy, so much difficulty to find, etc., etc. So nature is a far truer thing than code in terms of scarcity. Anyway, we're digressing. This major macro event is coming, which points to a major divergence in the economy. And when big shocks come, when that yield curve inversion breaks back up, and before I leave that chart, let me just highlight, it's lower than it's ever gone for the period from 89. Now, the last low that was actually beyond this low was 1981, which was the peak of the gold and silver bull market. So the only time that it's lower than all these lows in terms of how far it's dipped, lower than the Asian crisis of 89, long-term capital crisis of 98, the dot-com failure of 2000, 2001, the subprime failure of 07, 08 into 09 and everything that went with it, the repo liquidity failure of September, October. That was the only point that the yield curve inverted that led into the subsequent masking event created, in my view, of CV19 March 20th that saw a major flow of money coming into the market. Note how the actual crisis came after. Again, I am showing you something that is a leading indicator, not a lagging, coming from behind. Manipulating price takes a while to show up, smoothing it out, and it eventually pops, line crosses line for you. No, these all occurred prior. In fact, the major crash comes in the reversal back above. So you know you're about to get something pretty evil. Let's take, most people are around for COVID. The first dip negative was in and around the beginning of 2006. You actually started to reverse back up out of the yield curve inversion during 2007. Lehman's was in 2008, and this was already coming back out. Your Events of 2020, needlecraft. This started and caused a problem in 2019. And then again, Q3, September, October in 19, your event came. Here is the CV19 event on the period of the rebound. These are your crises here. This is a leading indicator. It tells you before. That's what you need. So at some point, this that has run the lows of all these other events, except from 81, well, that's past my data that I have, is telling you you've gone deeper and further than just about all these crashes. And Faulkner went to double digits, deep double digits on interest rate policy, by the way. So that was a negative real interest rate environment that served gold and precious metals very, very well. In short, inflation was destroying the buying power of the currency faster than you were earning interest on it by a substantial rate for a sustained period that destroyed the value of debt, which is why we've also called the turn in the bond markets. And that is a good thing for Bitcoin, because it's the loss of credibility of another asset class that most people have investments and pensions already in. Okay, so we're diverging a little bit, but this is a macro event. So if you think the data is going to be the same as 14 to 22, I keep minimizing that. I actually just need to go back to this chart. If you think the data is going to be the exact same or very close to, in terms of price, which means it's going to go up, down, whoop, you get a continuation on this one, so that's a little bit foxy, and then up, and then marginally up a little more, down, 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 longer than most people have thought for this bear market. If you think you're going to get that same data for that, then this indicator is fairly well optimized to potentially give you a trading signal. But once again, you'll see it in the price first. You went low volatility. The crash has got less. We've been squeezing and going low vol for a long time. We've been watching this volatility squeeze and wondering which way does the break go. Final capitulation or the first of a little bump? Does the bump just go up for a while? If the H2 of this year, because I'm having to push it out. So 3 key points. I was bearish for Q1 and H1. And now, one thing that has happened that I'm pushing out that bearishness for. So that is still a good call, but it's going to be a later call. Why? 3 things were occurring. American inflation was occurring and was out of control. The themes of 2022. Inflation globally, but particularly we were watching the American number on the global currency, the dollar. Energies, Europe. So that was the whole natural gas, the oil and diesel. we were expecting lockdowns, blackouts, all sorts of potential crises in terms of what they'd done and the stupidity of what they'd done by bifurcating the supply chain. And then the third thing was China complete COVID zero down. What has in fact happened since we've come into this new year and the run into the new year is actually warm winter for Europe, no grid down or blackouts, sourcing of supply. They've been buying up 700% more than they ever have of South African coal. They've been hooking and crooking to keep the lights on. So they didn't grid down everybody when we were starting to say it's almost inevitable. They didn't. They pulled every dirty trick at the back, many of them not sustainable. You look at America, they've run down their strategic reserves on oil. There's only some of these tricks. They've trimmed the fat and they've got away with it. So number one, the energy crisis of Europe never happened. Manufacturing never got to turn out, never had to switch off the lights, etc. China went back to work. They suddenly did a complete 180 and said, never mind COVID, we've got to go back to work. Everybody back to work, supply chain. They've kicked off. The tech index starts running again. Now they're open for business. They are suddenly open for business. So that's economic growth suddenly coming in that will sustain for a while longer. And then the inflation has been reducing, has been consistently reducing, and the Fed is threatening to continue hiking, which will include a 50%. So the 3 major themes that were in dire trouble, American inflation and also global inflation, but we watch the success of the Americans reining theirs in most because of the dollar and the treasury bills and the debt system. Europe energy, and China's complete COVID zero policies. All were terrible for growth and economic activity. What's happened is the most idealized, most optimistic event turnaround of all three. Complete success stories. So far, at least, anyway. And this is the rub. On the surface, for now, they look like success stories. But inflation is never killed once it's allowed to get this big. And it will return quickly on a whiff of fumes. But for now, the narrative is success. So we're going into an Indian summer mini bull market. But the tenuousness of these recoveries are built on many a bifurcated global supply chain wangle and weasel deal, which are probably not sustainable. Ergo, the coal going from South Africa, many other quick and dirty deals done, which were probably quite expensive as well, to secure emergency supplies, kickstarting overnight their coal furnaces in Germany, etc., etc. Anyway, we've taken a long departure, but I thought this was important to explain. So optimization is death, because optimization is on a certain data set that you're not going to get. Because there's no way you're getting an exact replay of the last 8 years you've just lived. That is the fallacy and the weakness of optimization. And these particular measurements, you have all forms of adjustable matrices, are optimized for the current data set. And that's why it creates an eye candy effect that looks absolutely freaking awesome as an entry set. And this is one of the most dangerous parts of indicator trading. It just looks so good. It is that fool's gold that gleams and shines, that you can't take to the bank. It's just going to leave you in pieces. So then we come to the ADX and the DI negative, the DI positive. I used to remember all of these things. I used to look at them. I'm so glad to have gone and forgotten them all. And essentially the one mirrors the opposite of the other. And I want to highlight that these were the signals. Look across, line crosses line, line crosses line, line is now crossing line. It's a foregone conclusion. We've just had line cross line 1, line cross line 2, line cross line 3. It's it. That's it. It's a bottom. What you've actually had is 3 price-based indicators that have all been affected by the data of an impulsive move to the upside. The driver's just turned left, and every little dead corpse, 3 different ropes tied to the bump, have all started to swing left in a slow arcing way and have lagged the input of the original price. So many times you get 2 data points, one there and one there. If you drop to a low time frame and you watch an RSI or an indicator, while the candle above, so if this is an RSI and this is a 10-minute chart and you're watching it, or a 5-minute chart, and here's your price trading on the candle, and the candle's going up and down, you will see the RSI go doom, and then the price goes up, it'll go doom, and then as the price goes back down, it'll flick doom, and it'll rub out this, and then the price goes back up again, and it'll go doom, and then the price goes back down again, it'll go doom, and everybody thinks the RSI is predicting, and it isn't, it's just responding. And then the price closes down and it goes doom. And it would have been up most of the time, but then the candle goes down and the 10-minute ends and you get a new one starting here. And now you're trading off this point where you were trading off that point. And then suddenly it gives a signal, you know, and then it will cross. What happens is the sell signal will look like it's occurred there. But it didn't. There's a gap. There's 2 data points, the one 10-minute and the next. It isn't giving you advance warning. It isn't giving you that because you'll see, okay, it's ahead of the price that it gave you that warning. No, it was a line joining 2 dots. And that dot only got finalized when the price finished its 10-minute candle. And it was flickering up and down the whole time. And when you look back at the indicator, you'll see on the line it's crossing the candle at the key moment, and you'll say it was earlier told you there, halfway through that line. It's not halfway through that line. It only got finalized here. You can't go back in time which is earlier, and put that trade on. Now that you know it traded down and it was a short and line cross line, you can't do it. And this is the fallacy of the indicators. When line crosses line, you didn't have that. It never was at that point. It was before it, and then it was above it instantly, because that's two different data points that are crossing. And that place where line crosses line is a point in time you could never get, because you only get the data that it's finished at the next point, and it's already through line. So the earliest you now get to go put on your trade after line crosses line is the next candle that has already started. So there's always a much higher lag for inputs, and then you get what I call multiple entries. 1 cross, 2 cross, 3 cross, 4 cross, 5 cross, 6 cross. All those are signals if you're just taking the DX. Then you get a cross here. Okay, so let's say there was a winning signal in retrospect. You would have had to take it 7 times, the 7th signal. You say, but I wasn't using it. This is another famous answer that will appear in the comments that goes along with the people that said, just because you weren't smart enough to make the indicator make money for you doesn't mean we aren't and everybody else's system is wrong. No, you're in a fallacy. You're in a fallacy. Look at the thumbnail of the circulating staircase where you're climbing. It is eye candy. It is fool's gold. What has happened is you've made money for other reasons. You went long during a bull market, or you caught the turn of an end of a big bear, and now you're going to misattribute your winning trade to something that happened here, instead of looking at the macro and saying, it is finely tied, you called a number of bottoms, but this was the one that turned out to be the bottom, and that was the point where you chose to be long, and coincidentally it was right, but in other instances this will let you down. So you will still get winners. 7th gave a decent signal. Then you got 3 signals, 8, 9, 10 and 11, all along here. You should have got out. You should have got out 3 times there. All bad. You should have got in, you should have got in, you should have got out, shouldn't have got in, you should have got out. 12 through to 15, and then boom, 1 signal. Now the implication is, I know there's weaknesses in one indicator. That's why I have other indicators to confirm. So that's a bit like saying, I've got a retarded worker who's blind, that can't really do hammering nails in. He keeps nailing his thumb instead, and I'm going to make it better by putting in a different disabled person, overlaying him, that will come with his own faults, and he's going to correct for the ones that are wrong on that indicator. So by combining lots of indicators, you're going to only keep the good bits, and everything else that is actually disabled and totally retarded about them are going to be cancelled out. This multiplying of error on top of error will filter out all the bad calls. And that, of course, is a huge fallacy, and it's a belief-based system in line crosses line. And we keep getting a lot of that too. So in the answers, I await confirmation. Another thing is you will hear, but I await confirmation. I am awaiting. The worst thing you can do if you have a legitimate reason for trading is to await confirmation. It absolutely destroys your risk reward profile. Much better to have real reasons for wanting to get long, a very tight stop, and accept this as a probability game where you are regularly wrong. Awaiting confirmation means it moves a whole bunch further. Your risk goes a whole bunch higher distance to stop because it's now pumping, and your reward that was up here now is significantly less than what it was when you were getting in early. Awaiting confirmation destroys risk reward profile. This is a regular accountant, stoic, wise, conservative thing to say. You just sound right. I'm going to await confirmation. So, you are calm, you're level-headed. No. By the time it meets the measure of awaiting that confirmation, your stop that needed to be where it first started moving low is now well extended, and the amount of ground, it reduces how much you can size for the same aggregate loss, if you understand management, and it's taken away from that upside. So far better to trade less, to be super certain, and then to go early with a tight stop. Hear that difference and know that there is a truth in there that many fail to grasp and understand. So the ADX actually gave 26 signals that were worthless and 3 that have aligned with something else, line crosses line. So how much worth it, given that there was a bull market, we're looking for an end of a bear. 26 line crossings were worthless for 3 that were worthwhile. What's your probabilities you make money? What's your probabilities that this is in any way contributing to your trading? Remember that we do low volatility to high volatility expansions that give an explosive reward with a tight stop. Most people's trades tell you they 1 to 2 or 1 is to 1.5 or 1 to 3. And when you look at their P&L of when they open, where their stop was placed and where they actually closed, are trading sub 1 to 1. Did you hear what I just said? And where did I get that from? I worked in an academy teaching traders. And I looked at what they did, not what they said. We downloaded P&Ls for everything they did, and we said, where was the stop on that entry? And they had to have it in. And where did you close it, your winners? And where did you close your losers that went against you? And countless times they gave more space to their losers and let their losses run, and they snatched their profits regularly. Now, as you get better, there's less of that, but this was the norm. And when you asked them, every single person thought they were trading 1 is to 2 or more, or 1 is to at least 1.5, and no one was trading even 1 is to 1. When you trade less than 1 is to 1, you have to be right 2/3 of the time. Right doesn't mean right, generally you are right, it's going up. No, right means you have 2 trades that win and take profits. Regularly you will have losers. A stop placement would get you out because it was too volatile, it dipped a bit deeper, your stop placement was wrong. It's a tragedy that most people do not understand the financial mathematics of successful trading. Anyway, we're back on the indicator fallacy, and this is a free lesson to you about where not to go. It looks absolutely freaking amazing. Line crosses line, line crosses line, line crosses line. If we get that H2, quarter 3, quarter 4, major smashdown on the fact that interest rates are significantly higher. They've gone higher than the previous highs before the Needlecraft events. What you will find is housing market is crashing in Canada, America, many other places. Prices have become really problematic in terms of getting in and getting out. There are already a lot of concerns about the labor levels. If that thing bites and you get a banking failure, what do you think will happen to all risk on assets in that environment? And do you think the Fed is going to be as fast as they were last time, which was not that fast? They were late. The entire stock markets crashed awfully. Bitcoin crashed to sub 4 grand. They came late, but do you think they're going to be quicker this time or slower? Quicker or slower? Quicker with a ring or slower? Without the ring wins, because they are out to destroy an inflation that they are responsible for creating, and they have a license to tighten till it breaks. Because why? Because inflation became runaway. They were late to inflation. They called it transitory. They ignored it. They said it was an anomaly. Then they called it transitory. Then they some degree of concern, and then they panicked and did 4 back-to-back 0.75% hikes in interest rates, my friends. So that macro fundamental concept associated with that indicator means you could get just like you got here. Everybody thought new bull. We called a top there on shooting stars. On candlestick, basic candlestick analysis, there's real resistance here. And that was at 14K. you traded 3.9 at that after the COVID lows. So you could get very similarly, even if you get the best outcome, a little head and shoulder reversal, inverted head and shoulder, a little bit of a rally to say 25, you could find yourself at 12 grand. That's not a prediction. I ain't saying it. I'm just telling you. And how will that indicator have worked for you? Well, if you go up to 25, everyone will say it's a success. If you go up to 25 as a result of this and this, they'll say it's a success. But it could also just be a line like this, where you've had that rally, you do go up, then you come back down and you get another down leg. Who knows? I'm not making a case either way. It could also be a bottom. And this, everyone will say it's a great call. It'll be a great call not because of the DX and not because of the DNVT. It'll be because you got momentum, you got the price going up, and this time it meant something. That will be the sole reason. And we falsely attribute, we get positive enforcement for negative behavior. So you will actually get to make money on something that is misassociated as to the reasons why you did. You're late in a bear, and it could indeed be a bottom too. It could indeed be a bottom too. So you'll note I haven't committed either way. So when I don't know, what I do is I say I don't know. And right now, I don't know. I don't know how long or how strong. And I do know that piano that should actually only be at 0.0000001% as a reason as to why I die, because I don't work under a piano retailer, is at 1%, and that's a million times higher, even though it's still very low. And that's because yield curve inversion, event-based risk, demand destruction, and that is most likely to be indeed very negative. So whatever move does come here could be truncated. And that is the thing that the indicator can't fix for you. That could be up, look good for a while, come back down, and be a very short tripper and back through that line. This could double back down like it did twice there and 3 times in a very short time space. Twice there in a row in a very short time space. 3 times there in a row in a very short time space. 3 times in a row there in a fairly short time space. Chop, chop, chop. Whipsaw, 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 jump in, jump out, always selling on the negative negative down legs, because you're on a lagging indicator that is responding to price that is now already turned down, and that's why line cross line, and now you're waiting, did it cross the line, or is it just touching it, or has it actually crossed it? By the time it's crossed it, the momentum is real, it's down, there's no bid, and you're getting murdered on your exits. In practical, you're getting murdered on your exits and you're getting murdered on your entries, because you're chasing movements of price go up and price go down. You have actually reverted to a momentum chaser via an indicating line crosses line, because you are trading a lagging indicator. You are watching the 3 different sized corpses hanging from different length ropes off of the back of the Ford Bronco, instead of the redneck with his hands on the steering wheel, the other one holding a beer and his foot on the accelerator. That is determining where the dead goat, the dead cow, and the dead cat are all swinging on their different lines, length of lines. And they are not 3 good reasons to go long. They're the same goddamn reason. Price went up with momentum. Okay, so remember, the things that are of value to you: volatility, patterns, and volume. We utilize all 3 to get a thin, and it's thin, edge in the markets that allows us to have a slightly higher probability on a low probability event that sees us gain more juice to the upside on tight risk than you would normally get in a random environment. And for that HVF method, I'm truly grateful, and you can find out more by booking a call. Otherwise, you can continue on your indicator journey of eye candy and impressions, and I warn you, it could become costly, and you will win just enough to keep you in the game so that you are slowly being bled out, And if you do your end of year P&Ls, you will see how much your little habit has cost you. And in most instances, people that think they are flat are deeply down. People think that they are up are actually flat or below flat when you take costs, brokerage, time invested, opportunity costs, and every other level in. So don't be fooling yourself. Snap out of it. Make 2023 a great trading year and get rid of the fallacies in the trading environment. And remember, for those of you that say, I'm not traders, I'm just investors. If you are investing is just a long-term position in something where you are determining an entry, and in truth, at some point, you should have criteria for determining an exit. So all you really are is an unleveraged long-term trader. So to my investor friends, look into my eyes, fantasize, I'm talking to you. You thought none of this applied to you. I'm talking to you, bud. You need to understand charts. You are an unleveraged long-term trader. Hear me again. You are an unleveraged long-term trader. That could mean you buy once and you hold for 3 years and then you sell. Most people will call that investment. It is. But you're also by nature an unleveraged. You need timing. You need the market to move. You can buy better and you can get out. Another big place where so many people make a mistake. The absence of targets, the failure to get out. People get out on pain. In the absence of targets, people get out in pain. And I've seen this on myself personally. I've seen it in the academy of people I've taught, and I see it in my community of traders. When things are going great, you hold, you want more. It's great every morning to get a great fat slice of dopamine and green number go up. Without a pre-contractual commitment to a process to take off, you get out on pain. Absolute fact. It becomes an arm wrestle of emotion and you get out on pain. And so many people round trip P&Ls. When they do get in good positions, they never lock in. And how do you determine a target? HVF method has a way for you, and even to hold for overperformance, to ensure that you don't do round trippers and give it all back. And that, my friends, is truly important. Okay, thanks to this guy for engaging me. He's got more than he asked for. There's nothing bad that he's doing. He's sharing his ideas. His charting is high quality. He shows respect. His annotations are awesome. No bads on anything. It's a discussion. It's a concept discussion. It's not a personal take. But indicators do not serve you where there are mathematically price-based manipulations. There is nothing predictive or even increases your edge than just reconstituting existing pricing information in a manner that it comes to you in a smooth, slower version. It's like being told the truth in Morse code given to you at 0.25x on your YouTube speed indicator. You get the answer a whole bunch slower and you've got a lot more decoding to do. Your best indicator is in fact the price, and having that blank chart is in fact the beginning of the game, and every book starts with a blank page. Don't ask for lots of smooth bullshit, security blanket, Stockholm syndrome, coward ass shit to be in place over you, like MACDs, moving averages, and other garbage. They do not help you. Price never bounces off a moving average any more than the truck suddenly turns right because the path of the cowards dragging behind it came directly behind it in a vertical line. It just doesn't happen. Price bounces because on that day, more people were aggressively buying the market up and had to chase the stack to get in than people were aggressively selling. That's why price went up. It really is as simple as that. Okay, till next time, your reality check on indicators. Don't let them dominate what you do. Do not swallow the placebo pill. And if you want to find out real method that utilizes real specific data, every single one that is leading, which allows you to predetermine before the event happens, an entry point, a stop loss, and a target that tells you what the risk reward is in advance, so that you can decide, is the juice worth the squeeze before it even happens. Plus gives you interim targets on the way where you should better go for a walk because it might not go in your favor for a while. If you know anyone else that has a method that does any of those things, plus a whole bunch more I haven't got time to tell you about, then do tell me. In the meantime, book a call on themarketsniper.com. Catch you later. Thanks for watching.